I'm going to go ahead and get started, everyone. I hope you guys can see my screen. If you can't, let me know so that I can go ahead and get it fixed. But we were just having a little bit of a technical difficulty. And I hope you guys can see it well now. Let me get the mic. Perfect, perfect. Okay, so today what we wanted to do is just go ahead and run through Schedule E and Schedule C income. For those of you who cannot, have not done these, this is for self-employed borrowers as well as for rental properties. So I am going to do it a little bit different today. So I'm going to show you guys some things to look out for, as well as do a little bit of a live calculation, so you guys kind of see what we look for as far as the income calculation. So we're going to go ahead and dive right in because we are a little bit late, and I do apologize again. I had some technical difficulties here. So we're going to go ahead and start with reviewing a Schedule C income. So again, for those of you who have not done a Schedule C income, what a Schedule C income is basically a self-employed borrower, a borrower who does not technically have an incorporation, or they could have an incorporation but do not file either 1120s. Some people do Schedule Cs. A lot of people do their 1120s. We are going to do an 1120 class soon, but for now we wanted to do it the Schedule C route. The majority of the people who use Schedule C are cash borrowers who are actually getting paid directly from clients and are not getting a pay stub. So cash borrowers, I mean, it could be checks, it could be cash. It's just basically their income that they're making is more of a business generated income that is being paid to them, like a DBA, or like an LLC. A lot of the times people use the Schedule C for LLCs. So one thing to review when you're doing income calculations, these are big pointers here that we wanted to bring up because it's something that we are noticing that in the underwriting department that are kind of being skipped over, is cost of goods sold, depletion, depreciation, deductible meals, business use of home, and business miles. So these are what we're going to be focusing on today, which is the majority of the business income calculations. So for income review, when we're looking at cost of goods sold, if you have a business that is being run with cost of goods sold, you need to make sure that your borrower does have a minimum of a 3-month availability to cover the cost of goods to be able to run their business. What does that mean? So let's say they're a produce company and they're selling produce to like restaurants or something like that. Their cost of goods is basically they have to go and sort them, sort their business with
I'm gonna go get my car.
produce. So basically what they're going to be doing is
Well,
produce.
because I left it like almost way
Hi,
down.
can you guys mute, George? Thank you. So basically what they're going to do is they're going to go ahead and go and fill their business with a bulk, product of produce, right? And then they're going to go to restaurants and sell it. So that's their cost to be able to run their business. So in order to run their business, they need to be able to have that product, right? So how we calculate that is we basically calculate a minimum of certain amount of months to be able to continue running their business. In this case, the majority of the time, it's going to be 3 months that we need to make sure they have available. So an example of cost of goods sold here, how you would, as you can tell, this borrower does not have cost of goods sold, but we have had instances where it has happened. Keep in mind, if this is a purchase, if they're using those funds to purchase, you are not going to be able to use those funds for your down payment or closing costs because you must have them readily available to run that business. An example here I have is, let's say they need to spend $125,000 a year to maintain that cost of good. So you're going to divide the 125 by 12 months, which will give you a $10,416.67. And you will multiply that by 3 months. So their cost of goods is going to be a minimum of $31,250 they need to have to run their business for the next 3 months. So just keep that in mind. This is a good one that we've seen that a lot of us overlook. I've overlooked it as an LO until, we had a case, right? So this is a great thing to review when you have a borrower that has cost of goods sold. Now keep in mind, if they do have other income on line item 6, this is something I did not bring up here. It does cancel each other out. You should put it on your income calculation, but just also keep an eye out for line item 6. Like I said, it does cancel each other out. What it means is that if they have a line item here or a number here, you basically subtract it and add it back. So, it's not really affecting your final income. Now, okay, here we go. So for moving on to the next one, depletion and depreciation. You can give these deductions back to the borrower. So keep that in mind. If you have depletion or depreciation on their expenses, these are expenses you can give back to the borrower when calculating income. It's something that you definitely want to look out for, because let's say they have all these deductions. I had a situation one time where the borrower was making 80,000, had all these deductions, but the biggest deduction was depreciation for 78,000 and change. You give that back, so you now, instead of having a negative $500 income, you now have 78 grand and change to be able to give this borrower back in income. Deductible meals. Another thing that we are seeing is that deductible meals are not being deducted. You must deduct this from the borrower's income when calculating their income for Schedule C. So if you do see the travels, it's only line item 24B that needs to be deducted from the income. So again, if you have a borrower that shows a final line item 31 of $5,000, but they have deductible meals of $2,950, you're cutting their income a lot. So just make sure that you guys are deducting your deductible meals. The next is your expense for business use of home. So we can give this income back, but it's only a portion. So you can give this income back. It's only a portion of the home that gets used in this deduction here, but it can only be for administrative or management activity. So keep that in mind. If the type of business that they're running, you have to make sure that it actually does qualify. And again, you guys can ask us if it does qualify. The majority of the time we see this is, again, they are administrative or management activity. So just make sure that you guys are also taking a look at this line item and you're able to give that back to your borrower on his income. The next thing is miles. When doing business miles, it's only business miles, not commute, not total, or I'm sorry, not other, but you can actually give your borrower business miles back. So the way that is calculated, and that's reimbursed into the borrower's income, of course, is it's based on a cents per mile. So in 2020, the cents per mile were 27 cents. In 2021, our cents per mile are 26 cents. So how you calculate that is you grab your miles and you multiply that by 26 cents, and you're able to give your borrower back an income of $25.61 and 52 on their business miles. So that's I'm gonna give you guys a sample right now, which is why I have this screen sheet right here. So I wanted to kind of just run through with you guys a sample of how we would look at an income calculation. So as you're, again, this is the one that I shared last week on income calculation. Keep in mind, it does have tabs under here, and you can go back and forth on the tabs to see these income calculations. And you can use your income calculation on business to calculate that income. I'm sorry, guys, this one doesn't do like a share screen of like a split screen. So I wanted to just run through and show you guys. So let's say we have this Schedule C borrower here, right? And we're going to calculate his income. So the way that you basically get started is, keep in mind, right now I'm only going to do 1 year, just so that we don't run through too much of this class. But keep in mind, if you're doing whether 1 year or 2 year, when you're using this calculator, you want to put the X on the amount of years you're using. And the reason for that is because it's going to calculate based on that X that you're placing on there. So let's say right now we're only using 2021. We're going to remove this X and it's only going to calculate this one here, and it's going to calculate for 12 months. If we place the X back on there, it'll calculate for 24 months. It'll automatically calculate for you. Now, one thing to note, if you have declining income, your calculator is going to decline, it's going to base that on your declining income. So let's start with this calculation. How you do this, I love this spreadsheet because it actually gives you what line items you're going to be inputting. It'll, mention it all there for you, which is great because then you know what line item to look at. So let's say we're going to leave the 2020 mark. So just so you guys can kind of see what I mean by dividing. We're going to place our line item 31 there. And we're going to go down the list, right? We're going to go look at item 6. There's nothing in item 6. So we leave that as 0. Nothing, and there's nothing to be, moved around here either. Depreciation, we have nothing. But business miles, we do. The cool part about this is you don't actually have to calculate it. This calculator will actually do it for you here. So you'll just do 9852, and it's automatically giving you that calculation I mentioned to you guys of 2562. Now it does round up in cents or down depending on what it's needed. Here we do have a business use of home. So we go back to our page 1 of the Schedule C, and we'll add that back. We have amortization. Here's another good one. I did not place this on here just because it's very rare that you see this. But when you do have some type of other expense on your other, just take a look at that and make sure that it is broken down here on your page 2 of your Schedule C as actual amortization. You cannot give other expenses back unless it's amortizations. So I did not place on there because it's very, very rare that we see it. But if you do see it, make sure you guys bring that up because you can include that in your income calculation. So now we go back to this line item here, 24B. So we're going to go back to our page 1 of our Schedule C, and we do know that we have deductible meals. And as you guys can tell right now, it's dividing it by 24. So I'm going to remove this just for a sec. So now, right now we have 82,036, right? Remember, this is a self-employed borrower. There's no way to get other money. So if we forget this, and then our underwriter comes in and deducts this, you just reduced it by almost $300. So that's why you want, a month. So this is already dividing it monthly for you guys. So you want to make sure that when you're doing your income calculation, that these numbers are all complete based on this calculator, because that way you don't miss the little things that can cost you. A $300 a month it can be big. It can be huge when you're doing your income calculation, especially for a self-employed borrower. Let's say they had depreciation of, let's say, $11,000 or, oops, sorry about that, guys. So as you can tell, that has now been added back, and look, your income just went up by, about $1,000 right there. So that's why you guys want to make sure you're looking at your income calculation and looking at how they've broken it down on their expenses, because I've seen a lot of people that just give us this divided by 12. Well, there's a lot of stuff that you do need to deduct and also reimburse for your borrower. So you want to make sure that you're doing, your borrower a service by giving them all the income that they can, use. Now, let's just say that, for instance, we're doing a 2-year. I'm going to make up numbers here just so that you guys can kind of see what the calculator does for you. Okay, so what I just did is I wanted to make sure that my last year was more than my current year. So what I want you guys to see is, if you guys see my total income last year was 101,000, it's currently 95, right? Well, what did my income calculator do? Remember, we had 24 months here because we had X'd both of them out, right? We had put both X's, meaning we were using both years to calculate. As you can tell, the calculator by itself went ahead and actually reduced it to 12 months. What did it do? It actually went with the current year. Why? Because when you have declining income, you cannot average your income for the last 2 years. Why? Because you're actually having to give your client what his current worst case scenario is as far as income goes. So in this case, his current worst case scenario was $95,872. Had we gone with the other income, which was, like I said, it's something that we do see is that we average it out by the 2 years. You will see what the difference in the income is. It's $82,220.29. So we're now giving this borrower almost $300 more in income that is not going to be able to be used because the income is actually declining from 2020 to 2021. So it's something we wanted to kind of show you guys. What we do see when we come into underwriting is that the income calculations, are done either incorrectly or are missing deductions or missing, anything that we can give back to the borrower, or are being averaged when you cannot average. If this was reversed, if this was 2021 and this was 2020, by all means, we definitely are going to divide that by 24 and give them the income of $8,220.29. But because our declining income was from 2020 to 2021, we are going to use only 2021 to calculate the borrower's income. So I know I went a little fast, but let me know if you guys have any questions. Yes, you can. Does anybody have any questions? You guys can unmute if you want. If you guys don't have questions, I'm gonna move on.
I have a question. This is Angelica.
Hi.
Hi. So for right now, for example, we are in the month of September.
Yes.
So I imagine that we need to get an estimated year-to-date P&L, right? Or balance sheet or something like that. Do we use that as part of our income calculation, or we don't? We just go off the last 2 years.
Now with FHA, they will use it as part of your income calculation if it's declining, not to increase your income. So FHA is a little bit, it's always going to be they're always going to go with your worst case scenario, right? It's unfortunate, but that's how FHA works. But when it comes to conventional, we only use a P&L to make sure that their income is still sustained and is still making approximately the same amount as average monthly. So that's what we want to see. We want to see that their business is still making income, and it's still, that's why we do need a CPA letter to make sure that they're still a viable business.
Okay, so just for clarification, so on conventional, we can actually average year to date plus the previous 24 months and give them the additional income, or no?
No. So what conventional is going to use is usually what they're going to do is they're always going to give you your worst of the two. If you're using 2 year, if you're using 1 year, of course, we're going to use your most current year. So like, for instance, right now we're in September. A lot of people, especially self-employed borrowers, have actually filed an extension for 2021. You can use 2020, so long as they've actually have filed that extension for 2021.
Okay, thank you.
And another thing, guys, and I did not mention this, and I should have put it on my slideshow. Keep in mind as well, if they're self-employed borrowers, always make sure that they've already set up either a payment plan with the IRS to pay back their tax portions, or they have actually paid the IRS the amount of their tax portion. In this case, I did not print my page 1 of this to show you guys what they would have owed the IRS, but always take a look at your page 1 and take a look and see if they're either getting a refund or owe the IRS. So this is huge when it comes to self-employed borrowers, because again, if they do have a payment plan with the IRS, if it's conventional, they're going to need the payment plan in place and one payment made based on the payment plan. So let's say they make the payment plan today, but their first payment is not due until October 1st, then they need to have that October 1st payment made on October 1st, and we need proof of that. If it's FHA, it's 3 payments that need to be made, and it cannot be paid in advance. So what that basically means is if they have October, November, December that need to be paid, those months need to be paid in that payment plan. So do keep that in mind when you do have a self-employed borrower, whether they have paid it in full or on a payment plan, because you are going to need proof of that when you're in, whether you're in a refi or a purchase transaction. If they're like refinancing to cash out and they're going to pay this off through the transaction, cool, by all means. But just, you know, keeping in mind that self-employed borrowers are always going to be held in a little bit, you know, they're going to have more tax liability. So you want to make sure that you guys do take a look at that. Any other questions? All right, guys. So
Yeah, one more question. This form, will you be sending it to all of us?
absolutely, I can send it out as soon as we're done. I'll send out the income calculation sheet. Everybody loves this sheet because it's a little more user friendly. Again, keep in mind, guys, at the very bottom, I'm pretty sure if you guys are seeing my calculation, you guys can see, look, there's so many forms under here that you guys can use. I love this sheet. Daryl brought this to us, our underwriter. And honestly, it's been a lifesaver with all of our transactions because we're able to, you know, make sure that we're calculating everything correctly. So this is an awesome form. I've loved this form. I don't think I've ever had a better form. Let me see here in the chat. Okay, perfect. Yes, I will send it out to everybody as soon as we're done. I know that last time that I had the basic income, some people you send it to me separately, but I'm going to send it out. Sorry, guys. I'm just trying to go backwards here. All right. So we are now going to dive in. If everybody's good with this one, I'm going to go ahead and dive back into our PowerPoint. And we're going to go ahead and review Schedule E income. This is a little bit easier. I remember when I started doing income calculation with Yessie, I was Yessie's assistant. I was like, oh my God, how am I ever going to get past all these incomes? You know, it's crazy. Honestly, as soon as I learned them and started like, you know, just actually, you know, putting hands on and learning how to use these income calculators, it was just like, oh, I'll do it. You know, it's fun for me. I don't know. I'm weird like that. When you do have a borrower, luckily this borrower had it. I mean, this borrower had it all. This borrower had Schedule C, had Schedule E. So when you're doing your income calculation for a Schedule E borrower, just keep in mind a couple of things. They can have more than one property. I've had borrowers that have 2 sheets of these and they're all filled up, or 3 sheets. So you want to make sure that you're doing every single borrower's income the borrower calculation sheet for every single property. Again, you can use in certain instances 1 year on supplemental income, which is your Schedule E for real estate. Now, this form is used for different things: real estate, royalties, S corporations. Again, it depends on the tax preparer and the borrower, but the majority of the time that we see here is, of course, for rental properties. In this case, we have a borrower who has 1 rental property. Always take a look at this type of property. This type of, this section, the type of property and your fair rental days. Guys, there's borrowers that have only rented it maybe half the year, and this was their 2021 taxes. You want to know why, right? So we're going to get a letter of explanation. If not, if they have the 365, then that's what you're basing this off of. Your calculation is going to be based on their fair rental days. Because let's say they only rented it for 180 days, half a year. Why? Well, maybe they had to do some repairs, and we have to calculate based on these days, because that income, that market income that we're going to calculate is going to be based on the amount of rents that they collected. So if we go in and we're calculating on 365, but they only rented it for 180, then we're cutting them short on the actual income. So again, you want to take a look at it, whether it's a single family. Now, keep in mind, I have seen tax preparers put a 1 and it's a multifamily. That's okay. You know, we've never had an issue with regards to that, as long as we're obviously proving that the property is a multifamily and your calculations make sense, then you should be okay. But you know, just do keep in mind that you're looking at what type of property is being marked here and how many fair market rents you're using it for. I've seen it where it has personal use and fair market use. Maybe they lived there for 6 months as per, you know, their primary, and then they rented it for 6 months. So you want to take a look at these sections here. So type of property, your fair rental days, your rents received. This is what you're going to be reviewing for your income calculation. Your total expenses, and I'll show you guys the full sheet right now. Your insurance, taxes, depreciation, HOA fees. That's one thing that a lot of us kind of skip over sometimes. HOA fees, mortgage interest, and repairs. The reason I put up repairs here is because you can give back a certain amount of repairs, and I'm going to get to that in a second. So for income review, you definitely want to take a look at, so I went ahead and highlighted what we can use here. You're going to review for income and deductions and how they will be used. So for instance here, line item 3 is what you guys received in rents, right? Your total expenses are here at the bottom of 21,968. And then everything in yellow is what you're going to be able to give back to your borrower. In this case, this borrower did have HOA fees. So they did have a pretty large amount here that we can give them back. If the property has an HOA, you can give that back to them. Now, it can be other things that are listed on here, but you cannot necessarily give back other unless it's HOA fees or, you know, some type of fee, like if it's a condo, or, you know, it could be a manufactured home that has a certain rental there. Yes, a Schedule E can be used for Airbnbs, Blanca. It just depends on how they mark it at the top. And it does actually state on here. Here, let me see if I can go back here. If you see here, it does say vacation or short-term rentals. So number 3, usually if it's like an Airbnb, would be marked here. So yeah, you can definitely use that for that too. So that's the cool part about this, is that, yeah, now that vacation rentals are coming like crazy with Airbnbs, you're definitely going to be able to use that rental income. So this is what you want to be able to use for your income calculation review. So when I mentioned about repairs, so why I wanted to bring that up is because I had a scenario years ago where I had a borrower that in the repairs, you know, on 1 year it said like, you know, $160. But the following year he had almost $18,000 in repairs, and I'm like, whoa, that's a huge jump. What happened? So what you can use line item 14, it can be used and you can give this back to the borrower as income on that 1 year if it's an extraordinary one-time repair. What does that mean? This borrower had to put a new wrought iron fence in the front because the old tenant literally like crashed into it and broke it. He had to remove a tree because the tree was starting to cause foundation issues. Tree removals can be expensive, 5 to 10 grand. I've seen it, you know, my sister has a palm tree. They told her to cut it off. It was like $5,000, even maintenance for the palm tree. Anyway, he had to do a few things like that. How can you be able to prove that these are one-time extraordinary fees or repairs? Receipts. One of the things that you do to be able to give this income back to the borrower, this expense, I'm sorry, is by giving receipts for the repairs that were done. That it's again a one-time extraordinary fee. This guy's not going to be repairing a wrought iron fence every month or every year. He's not going to be removing a tree every year. Or let's say he has to re-roof or re-tile, you know, because there was damage or something like that. Any type of repair that is one-time huge repair can be reimbursed to the borrower through this calculation if it is a one-time extraordinary fee. Just provide your receipts, provide an LOE, and you can give that back. So as far as the income calculation, so let's go into that. Before I start with that, do you guys have any questions on regards to that? No, you guys good? So again, I don't know why I like it. I just do. I think rental income calculation is cool. So let me just move this a little bit here. Yeah. So when using your rental income calculation, this sheet actually has two. It has one that, and I'm going to go ahead and open it up so you guys can see the whole thing. It actually has one where you have a borrower that has maybe more than one property, right? So this one actually, it's huge. It's got a bunch of, if they have more than one property, you need to do your monthly income calculation, or it has a single one if this borrower only has maybe one or two properties. What I like to do, and the reason I like to do it this way is because it just makes it easier for me. If you're having to use 2 years, I like to use this single one here for each property and use one line item for 2020, one line item for 2021. Just like your Schedule C, you do have to go with your worst case scenario. If last year they made more than this year, you're gonna go with this year, meaning 2021, sorry. If they made less in 2020 than 2021, you average, you grab your results and you average that income. So you're not going to give them the best case. You're going to, unless you're, again, you're going 1 year. If your DU or LP allows for you to go 1 year, perfect, we go 1 year. So when calculating income, again, this is really cool. It's telling you, now this one doesn't specifically tell you the line items, but you can match them up based on here where it says like total rents received. So rents received, it literally spells it out exactly how your sheet will have it here. So we're going to go ahead and I'm going to try to open this up a little bit more. Sorry, guys. All right. So this one will be here for this property, right? We're going to do 1234 Main Street, Los Angeles. So our total rents received is $21,600. Our total expenses would be down here, which is $21,968. And as you can tell, this form is already going to be calculating this for you at 12 months. If we were to just use rents received versus rent total expenses, we would be at a negative, right? So now we want to give them back the expenses of maintaining that property. We're going to give back their insurance. So now you can see our income calculation is increasing. We're going to give back mortgage interest. Sometimes they're free and clear. Sometimes they have mortgage interest. So mortgage interest here will be both for, $54.32. We're going to give back their tax expenses because, they got to pay taxes to maintain that property. In this case, it had an association, right? So we're going to give back the HOA dues. You can, because again, it's expenses to maintain the property. Another thing I do see sometimes is depreciation or depletion is not being given back. You guys can give that back. Look at how my income is going up and up and up. Now from $1,200, it went to $1,600. We don't have a one-time extraordinary fee in this case, but let's say that we did. Let's say that out of that $21,000, they had to pay 12 grand to fix something. So you're at $660. Maybe they had to re-roof it. Now you're at $2,660. So, giving that one-time extraordinary fee can be a huge factor when you're actually giving your income to your borrower. So as you can see, so now with this amount here on your guys's, when you're going into your schedule of real estate in Encompass, you will be using this amount right here and it's 100% of that, right? Because they've already actually put this on their taxes. So you're giving them, so let's say their mortgage, it includes taxes and insurance. And remember, you're already giving back HOA. So you're still going to hit them with that on the other section, but you're actually, let's say their payment for this is $1,200, but they're netting $1,660 a month in rental income. So you're able to actually put that, and it's 100% of rents received. So now in this case, guys, just keep in mind, this one does not average for you. You would have to average it. So let's say we had, one last year was 1560, and this year was 1660, then we will divide that by 24 months, and I'm sorry. It would be 1660 plus 1560, that's already monthly, so you would divide that by 2, and you would give them 1610. And that's getting your end result. And I'm just making an example. If for instance, last year they collected less rent and your final number here was 1560, then it's when you average. Now, and that's only if your current is higher than the previous. If it's the other way around, you're going to go with the lowest of the two. So let's say, last year was, 1660, but this one was 1560, then you're going to go with the lowest of the two, which is 1560. Now, this sheet, it's pretty cool. You don't need to use that only simply because, remember, you're already putting it into Encompass a certain way, and Encompass is already going to grab your PITI. So you don't need to do that. But what I love about this is going to give you your rent adjustment as well. If you want to play with this calculator, it will give you a rent adjustment based on your PITI. If let's say it's only P&I and not PITI, then you can add your property taxes, insurance, HOA, and it'll give you here your calculation based on your after cost of renting it and then whatever you're paying. So let's say their mortgage is $1,200 and their taxes is monthly is $260. Their HOA is $300. So if you notice, this is giving you a net loss of $100, right? You're not using this amount on Encompass, you're using this one here. Because remember, Encompass is already going to grab this on your REO section to go ahead and calculate for that. Now, let's say I currently have a borrower that had bought a property in December 2021. I won't have rental income, right? Because I'm not going to have a Schedule E because 2022 has not come to an end. They just bought the property, they just started renting it. How can I give them that income? You can give them that income, but because you don't have a deduction sheet like this, you are going to give them their net rent and divide that, their gross rent, and you're going to only give them 75% of that. So you're going to, for instance, I have a client who their gross rent is $2,000. I'm going to give them 75% of that, and I'm going to be able to give them $1,500 towards their mortgage payment. In this situation, I have a client who is collecting $2,000 a month, but I can only give them $1,500 towards their mortgage payment. Their mortgage is impounded, and it's $1,400, but they do have an HOA of $46. So I may not get a huge amount of income off of that, but the cool part is it's actually canceling out my other mortgage and giving me a net rental gain of about $46 a month, right? So they're able to purchase another property here because they had this property in Arizona. What we would need with that is we're definitely going to be needing a lease agreement or a rental agreement and at least 3 months of income. So guys, remember the rule is anywhere from 2 to 3, right? At least 3 months of them collecting that rent. So they need to be able to show proof that they're actually collecting the rent. So in this case, I have bank statements because the borrower actually Zelles the money to the client. So I'm able to prove that for the last minimum of 3 months, they've been collecting $2,000 a month for their rental property that they just bought. Quick little LOE, I just bought this property. I started renting it in so-and-so date. I'm collecting this amount of money, and the renter Zelles it to me. Or if they give you a check, show proof, just showing that proof so that you can be able to use that income. But again, because it's not on your taxes yet, you can only give them a 75% rent. Now, any questions, guys? Yes, so we are going to need at least a rental agreement or lease agreement on top of the 3 months. Yes. Anybody else have any questions? So that was,
Question. Okay, so let's say they live in a condo, right? And now
yes,
they're moving into a single family residence. So the condo becomes their departure residence. Can we
Yes.
still use the 75% of the proposed rental agreement?
yes. So in that case, if it's a departing income unit, sorry, not a departing income unit, but they are gonna now gain income. The only thing that we do need from that is the lease agreement. And I mean, this is a case by case scenario because a lot of the times they don't, it just really depends, but you want to at least have a deposit in and it's cleared into your account. So what they used to do before is they would order a 1007, right? They are no longer really requiring 1007s. Sometimes they might, it just really depends if it just looks like it's like, you know, like it's just not a feasible rental amount, because we do check, you know, to see if it's if the rent amount, you know, like I had an instance where they were telling me $3,600 for rent on a house. And I'm like, whoa, market rents over there are no more than about 2,900. We are going to make sure that those market rents do coincide with the market area. So yes, you do 75% as a departing income of whatever the market rent in the area is. And it just has to be reasonable. You know, we do all know that rents have gone up, but market rents, you know, like Rentometer is a great tool for you guys to use. Or anybody who's also a licensed agent, you know, realtor can check the, you know, the MLS to see what's the market rents in that area. But there's a lot of ways to be able to tell what, but yes, so even if it's a future lease agreement, let's say they're closing this month and they're going to move in November, that's okay. You know, the borrower needs time to move out, right? So as long as we have a lease agreement, we can give them that 75% of the market rent. And yes, on Encompass, you can put it as a departing. So it will show on your REO as a primary, and then it'll say will be used as investment. Any other questions, guys? I'm liking all these questions, by the way. I love when you guys ask questions. No questions? If there are no more questions, guys, I hope you guys enjoyed this class. I did want to mention again, we're going to continue to be having classes like this, you know, every week. We do reserve the last week of the month for all of our loan officers to concentrate more on their closings. You know, last month, everybody wants to close and meet, you know, quotas and all that good stuff. So every last week of the month, it's not going to actually be a class, but if you guys do need a refresher or anything like that, you can call me and we can have a one-on-one because I will be here available. Our next class is going to be how to set up your Surefire, and that's on Thursday. So it's just going to be the basic setup of your Surefire, adding, you know, contacts and all that good stuff. And then we're going to start diving deeper into it every week. So we want to be able to kind of make it easier for you guys to use and use and abuse the you know, the marketing tools that we have for you guys as our loan officers. But I hope you guys enjoyed this class. Again, my goal is to help us, you know, continue to be educated to be able to sell more out there and especially close faster, you know. So again, just to reiterate, if you guys have any suggestions on classes, please feel free to email me. I will shoot out an email with this income calculator worksheet to the group. And again, if you guys have any questions, please feel free to email me, contact me direct. I really appreciate everybody. Thank you all so much. And that's it. Have a great rest of your day, everybody. Wait, I have one more chat.
Thank you.
Thank you, Candy. Thank you, everybody. I'll see you guys in the next one.
Well, it's kind